Hello, welcome to the session on the industrial engineering. So our topic is engineering economic. So in the engineering economic, the main thing is the introduction to the costing. That is our today's topic. So we'll be covering over here the different types of different types of costing. Okay. Then the main important feature in this so first is the cost. So it is the amount of expenditure incurred on or attributable to a given thing. Okay. Then the next one is the accounting. So when you say a cost, then it should be accountable. So it should be in the form of accounting. So it is the art and the science of the recording business transactions in a methodical manner so as to show true status of business at a particular instant of time. Okay. Now whenever you can combine cost and the accounting, it may result in a kind of standard costing. So whenever you are saying it is the costing, or you can say whenever you can say it is a standard costing, so it is concerned with analysis and the determination of cost, relation of cost with sales, then finding profitability, then managerial decisions and continuation of business. In the previous lay, that is indirect material. Okay. So indirect materials may be, it may be grease, oil, lubricants, cotton waste, etc. It may be small tools, brushes for sweeping, sundry supplies, then cost of threads, gums, nails, then consumable store, factory printing, stationery. In the indirect wages, which is related to the labor, so salary of factory manager, then no, not foreman, supervisors, clerks, then salary of storekeeper, salary and fee of factory directors and technical directors, then contribution to ESI, then PF, then leave pay of factory employee, which is all related with the human concerning the production. Then the third one is the indirect expenses. Okay. Indirect expenses, that is the rent of the factory building and the land, insurance, then municipal taxes, depreciation of factory building, plant machinery and repairs and the maintenance, then power and fuel used in the factory, then factory telephone expenses. So these are being required for making a particular product and for making a particular production. Okay. Then we are having the cost relationship. In the cost relationship, so first one is the primary cost, that is equal to direct material cost plus direct labor cost plus direct expenses. Another thing is factory cost. Factory cost is prime cost plus factory overheads. Okay. Then comes total cost. So factory cost plus selling overheads plus distribution overhead plus administrative overheads. So it includes all the costs. Then selling price. So a product selling price will be equal to total cost plus or minus profit or loss, that being taken into account for calculation of the selling price. Okay, that is what is the cost relationship. Now there are certain things which is called as classification of the cost. So in the classification of the cost, so first one is the cost behavior basis. So it may be fixed cost, which is directly related with the production, then variable cost which changes, and the semi variable cost, it may be a combination of fixed, some part of combination, some part of fixed, some part of variable cost. So it may be a semi variable kind of cost. So what may be the variable cost? It may be a change in cost per change in the output. Okay, so that may be, we can say it is a variable cost. Okay. Then on the basis of the cost inventory, so whenever some inventory is being stored in the company, some cost being incurred, so that inventory can include the product cost, that inventory can be included with the period cost. So some product are being hold for some time, so that holding, so that holding period being called as period cost. Okay. Then cost in relation with the cost center basis, that is direct cost and the indirect cost. Now the main important part for our this is break even analysis. So break-even analysis is a financial tool to determine how much sales volume your business needs for making a profit. Okay, so it also useful when you are developing a pricing strategy. Then the break-even point, under the break-even analysis, the break-even point, it is the point at which cost or the expenses and the revenues are equal. That means total cost is equal to total revenue. So that is the thing. So we can say there is no loss, no gain, and one has been called as broken even. So that's why the name is being given as break even. Okay, so there is no loss, no gain, and has the broken even. Okay, so that is being called as break even analysis or break even point. Is in this particular say, we can say it is a margin of safety. So above this particular portion, above the break point, whatever the region between this particular area, this thing called as margin of safety. So you have to play between this margin of safety, that is total sales minus BEP sale, break even point sales. So that is being called as margin of safety. Again, we require the profit to volume ratio, which is equal to contribution upon the sales volume multiplied by 100. So this is the contribution upon the sales volume multiplied by 100. Again, what we require is profit. Profit is equal to, it should be is equal to SP minus VC, that is contribution multiplied by quantity minus fixed cost. So that is, we can say it is leading term as profit. Then we will solve some one numerical on break-even analysis. So let us say the data being given. So fixed cost is equal to 40,000, variable cost is rupees 2 per unit, selling price is rupees 10 per unit. Calculate break even. Then profit when the sales are rupees 1 lakh. Then sales when it is desirable to earn profit of rupees 30,000. So consider this data. So first find break even point in unit, that is equal to total fixed cost upon contribution per unit. Contribution will be equal to SP, selling price minus variable cost, that is 10 minus 2, that is equal to rupees 8. Okay, BEP in units, that is equal to total fixed cost upon contribution, that is coming as 5,000. So if you are calculating in the rupees, multiply with the selling price is 10 per unit. Okay, so this is the quantity and these are the number of units. So 5,000 multiplied by 10, that is equal to 50,000. Or you can also calculate break-even point in another way. The another formula is break-even point is equal to fixed cost upon P by V ratio, profit to volume ratio. So P by V ratio will be equal to selling price minus variable cost upon selling price. So it is coming as 0.8. So 40,000 divided by 0.8, it is being coming as 50,000. So answer will be same by using the both the methods. Then second is profit when sales are rupees 1 lakh. So profit will be equal to sales, number of sales, selling price. Sales is 1 lakh. Okay, multiply by P by V ratio minus FC. So 1 lakh multiplied by 0.8 minus 40,000, that is being coming as 40,000, because it is 80,000 minus 40,000, that is coming as 40,000. So profit when sales are rupees 1 lakh, the profit will be 40,000. Now sales to earn rupees 30,000 at profit. So our main aim is to this one, that is we are forecasting the sales to earn to rupees 30,000 as profit. So sales in units, that is being coming as fixed cost plus profit desired upon contribution per unit. Okay, 40,000 fixed cost, 30,000 considered as profit upon contribution per unit, that is equal to 8, that is coming as 8,750. Okay, if you are calculating sales in the rupees, that being fixed cost plus profit desired upon profit to volume ratio. So 40,000 plus 30,000 divided by 0.8, that is coming as rupees 87,500. Okay, so in this way we can solve the different kinds of numericals on break-even analysis. Then the next is why, when, and where to use the break-even analysis. Say first phase of the business, starting of new business, creating new product, challenging the business model. So this is the first phase for any kind of business. Then the second phase, that is after production, when production goes on, then pricing analysis, technology analysis, cost analysis, outsourcing, that is the primary phase. Then after phase, after production, that is catch missing, or we can say some modifications should to be done in the company. So catch missing expenses, set revenue target, make smarter decisions, then cover fixed cost, then fund your business or better pricing. So initial phase, then mid phase, and the final phase. So in all the three phases of the business or the production, so it will help, break even analysis will be help. So we can use the break even analysis in different forms. Okay. Then thank you. So if you like the video, then like it. Also please subscribe my video by on the YouTube channel by pressing the bell button, and never miss the updates. So thank you.